You're sitting at home looking at the $200,000 to $300,000 in home equity you've built up as prices stabilized in 2026, and you see HELOC ads everywhere. Tap into your home's equity easily, low interest. Use it for home improvements, travel debt consolidation, investing. Whatever you want. You think Fed rates are easing. HELOC variable rates are around 8% right now, pulling out $100,000. Feels comfortable, I can pay it back slowly. It sounds too good, right? A lot of people do exactly that, and they feel like they're smartly leveraging their house to get ahead. But 1 to 2 years later, the nightmare kicks in. The Fed suddenly reverses course because inflation flares up again. The prime rate jumps 1 to 2%, and your HELOC rate spikes to 10 to 11%. Your monthly payment shoots up $200 to $400, or even doubles if you borrowed big. You struggle to keep up, but your income isn't rising fast enough. Unexpected repairs hit kids, need extra activities. Where's the money coming from? You start using credit cards to bridge the gap, debt snowballs, and suddenly you're deeper in house. Poor territory, crushing monthly stress, afraid to change jobs, no room for vacations or life changes, and worst of all, fear of losing the house because HELOC is a second lien. The bank can foreclose if you default. This isn't rare. In 2026, according to Experian and Bankrate average, HELOC rates are hovering at 8% plus, but forecasts show high volatility if economic conditions shift. Geopolitical tensions, supply chain issues. Millions of homeowners have substantial equity, yet 15 to 20% of HELOC users end up regretting it due to rate spikes or overborrowing. Consumer Affairs data. Foreclosure risk rises sharply when HELOC turns into a hidden debt trap. You think you're unlocking freedom, but you're actually turning your home into a heavier burden. Continuing our series on house poor hidden costs and down payment myth. Today we dive into the HELOC danger, why using a home equity line of credit in 2026 is riskier than ever, the 7 biggest dangers, the brutal math over 5 to 10 years, and exactly how to avoid it so you don't lose your financial freedom forever. If you're thinking about opening a HELOC or you already have one and are worried about rates climbing, watch this entire video. It could save your finances before it's too late. Let's get started. In 2026, using a HELOC feels tempting because home equity is still high. Many middle-class families have $200,000 to $300,000 built up from years of appreciation and payments. Median home prices are stable around $430,000 to $450,000 per Redfin and Zillow forecasts, with only modest 2 to 4% growth expected this year. That stability makes homeowners feel safe. My house is worth more, equity is locked in, why not tap it? But the real danger comes from the structure of HELOCs themselves. Unlike your primary mortgage, which is usually fixed rate, most HELOCs are variable rate tied directly to the prime rate plus a lender margin. Right now, average HELOC rates sit at 8%, plus Bankrate and Experian data as of early 2026. And while the Fed has been cutting rates slowly, forecasts show high uncertainty ahead. If inflation ticks up again, geopolitical tensions flare, or supply chain issues return, the Fed could pause cuts or even hike, pushing prime rate and your HELOC up 1 to 3% in months, not years. This volatility hits harder in 2026 because economic conditions are fragile. Middle-class incomes, $80,000 to $200,000 household, aren't rising fast enough to absorb sudden payment jumps and hidden costs, repairs, taxes. Insurance continue climbing 5 to 15% annually. According to Trust Financial Group and Consumer Affairs, HELOC usage has surged as people consolidate debt or fund lifestyle expenses. But 15 to 20% of users already regret it when rates move against them. Take a typical family earning $150,000. They pull $100,000 HELOC at 8% to renovate or pay off credit cards. If rates rise to 10%, their monthly interest alone jumps by about $167, not counting principal draws. Add that to their existing mortgage, and suddenly 40 to 50% of take-home pay is locked in housing debt. Classic house poor escalation. This isn't just possible, it's the new normal in a volatile rate environment. Now let's break down the first major danger variable: rates that can spike your payments without warning. Danger number one, and the one that catches most people off guard, is the variable rate nature of HELOCs, which can spike your monthly payments unexpectedly and turn a manageable line into a financial nightmare. HELOCs are almost always variable rate, meaning your interest adjusts monthly or quarterly based on the prime rate, currently around 7.5 to 8%, plus your lender's margin, typically 0.5 to 2%. Unlike a fixed-rate home equity loan, there's no cap on how high it can go. In 2026, with the Fed still navigating inflation and growth, even small rate hikes can hit hard. Here's the brutal math. Suppose you draw $100,000 on your HELOC at today's average 8%. Your interest-only payment common during the draw period is about $667 per month. If the prime rate rises just 2%, very realistic in a rebound scenario, your rate jumps to 10% and that payment increases to $833, a $166 monthly hit. On a $150,000 draw, it's $250 plus more per month. If you're also paying principal during the repayment period, 10 to 20 years after draw, the increase is even steeper because you're amortizing a larger balance at higher interest. Real example: a family in 2025 opened a $120,000 HELOC at 7.5% for home improvements. In early 2026, rates ticked up 1.5% due to inflation signals. Their payment rose from $750 to $900 monthly. They couldn't absorb it, started missing other bills, used credit cards, and debt snowballed. Within a year, they were in full house poor mode, cutting back on everything just to keep the house. This isn't hypothetical. Bankrate and Experian warn that variable rate products like HELOCs amplify risk in uncertain times, especially when your primary mortgage is already fixed and eating 30 to 40% of income. The math is foo-fang. A 2% rate spike on $100,000 can cost you an extra $20,000 plus over 10 years in interest alone, plus stress and lost opportunities. HELOCs promise flexibility, but variable rates turn them into a gamble. Next, the ultimate danger if you can't keep up the risk of losing your home entirely. Danger number two is the scariest one. If you can't keep up with HELOC payments, you risk losing your entire home, not just the borrowed amount. Remember, a HELOC is secured by your house as collateral, just like your primary mortgage. It's usually a second lien, meaning if you default, the lender can foreclose on your property after your first mortgage is satisfied. In 2026, with HELOC rates already at 8% plus and potential spikes ahead, default risk is higher than most people realize. According to CBS News and Bankrate reports, second lien products like HELOC carry elevated foreclosure danger compared to primary mortgages because lenders prioritize the first lien in recovery. If rates rise and your payment jumps, or if life hits, job loss, medical bills, missing payments can snowball fast. Real example: a family with a $500,000 home pulls $80,000 HELOC at 8% for a dream vacation and home upgrades. Everything's fine for a year. Then rates climb 2%, payments rise $150 per month, and the husband loses his job. They miss a few payments trying to catch up. The lender starts foreclosure proceedings. Even if they sell the house quickly, closing costs, late fees, and legal expenses eat into equity. Worst case, they lose the $500,000 home over an $80,000 line they couldn't afford when things went wrong. The brutal math: foreclosure isn't just losing equity, It destroys credit for 7 years, blocks future borrowing, and forces renting at higher costs. AmeriSave data shows HELOC defaults often lead to full home loss when combined with primary mortgage strain. Advice: only open or draw a HELOC if your income is rock solid and stable. No, maybe I'll pay it off later mindset. This isn't a safety net, it's a loaded gun pointed at your house. And that risk grows even bigger when people overborrow because it feels too easy. Danger number 3 hits close to home for many: the psychological trap of overborrowing, because HELOCs feel so accessible, and once you start, debt snowballs fast. HELOCs come with checks, debit cards, or easy online transfers, making it feel like free money sitting in your house. You draw a little for a kitchen remodel, then a bit more for a vacation, then more to pay off credit cards. It's painless at first, no hard inquiry, no immediate principal payments during the draw period, usually 10 years. But that ease leads to overspending. According to Trust Financial Group and Consumer Affairs, average HELOC draws in 2026 range from $100,000 to $150,000, but up to 20% of users overborrow beyond what they can realistically repay. Guaranteed rate data. Personal example: imagine you pull $120,000 to consolidate debt and treat the family. Monthly interest at 8% is only $800, feels manageable. But life happens: car repair, kids' school fees, unexpected roof leak. You draw another $30,000 to cover it. Now you're at $150,000. Rates tick up to 9.5%, interest jumps to $1,188 per month. You're still only paying interest, so the balance doesn't shrink. Credit card debt creeps back because you're stretched thin. Debt snowball starts, higher interest compounds. Equity shrinks if home values dip. 2026 volatility risk, and you're locked in slower wealth building for years. The brutal math. That extra $50,000 overborrowed at 9% interest costs you $4,500 per year. In interest alone, money that could have gone to retirement or investments at 7 to 9% returns. Over 10 years, it's easily $60,000 to $100,000 in lost opportunity, plus stress and lifestyle cuts. This is classic house poor escalation. You feel richer temporarily, but the debt trap tightens. Equity is supposed to build wealth, not become a revolving credit card. These dangers compound when market conditions turn against you. Danger number 4 is quieter, but just as destructive over the long run: the massive opportunity cost of pulling equity out of your home instead of letting it grow or investing it elsewhere. When you draw on a HELOC, you're not just borrowing money, you're reducing the net equity position in your house. That equity was supposed to appreciate quietly over time. According to NAR and Zillow long-term data, home prices in stable markets have historically appreciated around 3 to 5% per year on average. In 2026, even with slower growth forecasts, 2 to 4%, that still compounds meaningfully over a decade. But when you take $100,000 out via HELOC at 8% interest, you immediately start paying $8,000 per year in interest, assuming interest-only draw period. That's $8,000 leaving your pocket every year, gone forever. Now compare that to what happens if you leave the equity untouched and invest the equivalent amount elsewhere. Historically, a balanced stock/bond portfolio returns 7 to 9% annually, S&P 500 average after inflation. That same $100,000 invested could earn you $7,000 to $9,000 per year in gains compounding. Real example: a homeowner draws $100,000 HELOC to pay down high-interest credit cards. They save maybe 5 to 6% on credit card interest, but pay 8% on the HELOC instead. Meanwhile, if they had left the equity in the house and aggressively paid down other debt from income, that $100,000 would have grown to roughly $150,000 to $180,000 in 5 years through appreciation and compounding market returns. Instead, they're paying interest and have less net worth. Over 10 years, the missed opportunity easily reaches $50,000 to $100,000 plus. The brutal math. Every dollar you borrow via HELOC is a dollar that stops working for you in appreciation or investment growth. You're trading long-term wealth acceleration for short-term convenience, and the cost compounds quietly for years. This opportunity loss becomes even worse when external factors turn against you. Danger number 5. Market volatility can turn your HELOC into an underwater nightmare. Home values aren't guaranteed to keep rising. In 2026, while prices are stable overall, regional markets remain volatile. Supply chain issues, interest rate swings, or local economic slowdowns can cause flat or even declining prices. Guaranteed rate and Redfin forecasts. If your home value drops 5 to 10%, your equity shrinks, but your HELOC balance stays the same or grows if you're still drawing. Suddenly you're underwater on the line, owing more on the HELOC than the remaining equity covers. Selling becomes painful or impossible without bringing cash to closing. Danger number 6. Potential tax changes could eliminate or reduce your deduction benefits. Right now, HELOC interest is only deductible if used for home purchase/improvement. Post-2017 TCJA rules, but in 2026 and beyond, tax policy remains uncertain. Kiplinger and tax analysts warn of possible law changes under new administrations or budget pressures. If deductions are further limited or eliminated, the after-tax cost of your HELOC rises significantly, making it even more expensive than it appears on paper. Danger number 7. Broader economic uncertainties can amplify every other risk. Inflation returning, geopolitical events, recession signals, or unexpected Fed policy reversals can push rates higher quickly. Experian and bank rate warnings. These aren't in your control, but they directly increase your HELOC payment, reduce your home value, or threaten your job/income, creating a perfect storm. Combined example: a family draws $150,000 HELOC for renovations. Rates rise 2%, payments jump $300 per month. Home values dip 8% in their area. Tax deduction gets capped, job market softens. They're now paying higher interest, have less equity cushion, and face possible job loss all at once. Total financial damage: $50,000 to $100,000 plus in extra interest, lost appreciation, forced selling costs, plus years of stress and limited options. The brutal math. These risks don't just add up, they multiply. One missed factor can wipe out years of careful planning. So how do you protect yourself from these dangers? Let's move to the practical ways to avoid the HELOC trap entirely, or use it safely if you must. So how do you actually avoid falling into the HELOC danger in 2026 and protect your home, your equity, and your financial freedom? Here are the realistic step-by-step strategies that smart homeowners use to either stay away completely or use it safely if they must. Advice number 1, only draw on a HELOC for true emergencies, not for lifestyle upgrades, vacations, or short-term luxuries. Consumer affairs and financial experts emphasize that HELOCs should never fund depreciating or short-lived expenses. If it's not something that directly increases your home value or solves a critical problem like major medical bills or preventing foreclosure on the primary mortgage, don't touch it. The temptation is huge, but regret follows fast when payments rise. Advice number 2, if you absolutely need to borrow against equity, consider a fixed-rate home equity loan, HE loan, instead of a variable HELOC. CBS News and Bankrate highlight that fixed-rate options lock in your interest rate, currently around 7.5 to 9% in 2026, eliminating the spike risk. Yes, the rate might be slightly higher up front, but you get predictability, no surprises when the Fed moves. Advice number 3, keep your total debt-to-income ratio, DTI under 40% even after drawing and maintain a 12-month emergency fund in cash before ever opening a line. Bankrate stresses this buffer is non-negotiable. HELOCs are not an emergency fund, they're leverage. If a rate jump or job loss hits you, need cash reserves to cover payments without drawing more. Advice number 4. Run the full 10-year cost projection before drawing a single dollar. Assume rates rise 2 to 3%, very plausible in volatile times, and calculate total interest paid. Tools like Bankrate's HELOC calculator make this easy. Example: a family earning $150,000 considers pulling $100,000 at 8%. They model a 2% spike, payments rise $167 per month. Total interest over 10 years jumps $20,000 plus. They decide against it, instead aggressively investing the equity equivalent in a diversified portfolio at 7 to 9% returns, ending up $50,000 plus richer. Common mistake to avoid: rates are low, now better borrow while cheap. That logic fails when rates rise. You're locked in paying higher interest on money you may not need anymore. These steps flip HELOC from a trap into a control tool if used at all. Now let's wrap this up with the final takeaway. To wrap it up, in 2026, HELOC is not a safe, easy tool for unlocking wealth. It's one of the riskiest financial moves you can make right now. Variable rates that can spike without warning, the real threat of foreclosure. If you default, the temptation to overborrow leading to debt. Snowball: massive opportunity cost from lost appreciation and investment growth, plus market volatility, potential tax changes, and broader economic uncertainties. All these dangers stack up to make HELOC far more hazardous than in low-rate eras. The brutal math doesn't lie. What starts as just $100,000 at 8% can easily cost you an extra $20,000 to $50,000 plus in interest over 10 years if rates rise just 2%, plus tens of thousands in missed returns if that equity had stayed invested or appreciating in the house. Worst case, you lose the home entirely over a line of credit that felt like free money at first. This ties directly back to our series House Poor isn't only from the primary mortgage, it gets exponentially worse when you layer on HELOC debt. Hidden costs explode when variable payments eat your cash flow. Down payment myth. Low down buyers often turn to HELOC to cover gaps, creating a double trap. Final advice: prioritize building cash savings and alternative low-risk debt options. First, personal loans, 0% balance transfers if possible. If you must use equity, go fixed rate HE loan. Keep DTI under 40%, monitor rates monthly, and treat every draw like a serious loan, not an extension of your checking account. Most importantly, equity is an asset for long-term wealth and security. Don't turn it into a debt trap that steals your freedom. The math is foo-fang. Your home should build wealth over decades, not become the source of monthly stress and potential loss. Protect it fiercely. Now I want to hear from you. Are you considering a HELOC right now? What's your household income, current equity amount, and what you're thinking of using it for? Drop it in the comments. I'll personally reply with a quick risk analysis tailored to your numbers and 2026 conditions. If this video helped you see the real dangers or saved you from a bad decision, smash that like button, subscribe, and turn on notifications for more 2026 real estate truths. No hype, just the hard facts and math. Thanks for watching. Keep your equity working for you, not against you. See you in the next one.